We've talked about how oil is produced and consumed. We've talked about the integrated oil market and the oil market structure. We've now introduced futures markets and how futures are traded. And so we can now talk about the modern oil market, oil price movements, trends, volatility, speculation, and OPEC. This is where it gets fun. So what explains trends and volatility in the price of oil? So on this graph, this is the price WTI oil price from 1985 to 2015. When I say trend, I'm talking about a longer term upward or downward trend. And so you can see on this that I've kind of given the trend line from the early 2000s through 2008. There was an upward trend, and we'll talk about what caused this upward trend in this talk. And then when I talk about volatility, I'm talking about these shorter term fluctuations. You see that there's a lot of volatility in the price of oil. It's not a steady line. There's a lot of movement, the short-term movements. And the trends are caused by market fundamentals, things like supply and demand, while the volatility is caused by the modern oil market commodity trading scheme, the futures market. So here's a list of some things that move oil prices. Financial markets, these are the commodity markets that we've been introducing in this module. We have investments, real investments, and then we have speculation. And we'll talk about the role of each of these in modern oil prices. Then we have fundamentals, supply, demand, and what's known as precautionary demand, which is sort of a demand that's specific to the oil market. Speculative bubbles in oil prices. So what we're going to look at first is a paper that asks, what is the role of speculation, not investments, but speculation specifically on causing upward trends in oil prices or downward trends in oil prices? A popular theory is that oil price movements in the past decade were caused by financial speculators buying oil futures contracts with the anticipation that the oil price will rise, creating what's known as a speculative bubble. This happened in 2008 in the housing market. Does it happen in the oil market? Buying and selling futures in response to changes in fundamentals is not speculation. So changes in fundamentals being supply and demand, or the thought that supply and demand are going to change in the future. This is not speculation. Some of the transactions on futures exchanges can be classified as investments. So if you're buying and selling in response to changes in fundamentals, that's an investment. This is hedging against oil-related risks. For example, farmers use diesel for tractors, or owners of small oil wells in Kansas. If you think the price of oil is going to decline in the future, you want to lock in the price you're going to sell your oil at in the future, or corn, or any commodity. So this is using the futures market as an investment. You want to, if you think the price of oil is, if the spot price is $30 per barrel right now, and you think it's going to go down to $10 per barrel, you want to lock in the $30 price for the next 6 months or something, and that would be using the futures market to do that as an investment. You can also do it to diversify a portfolio, like a pension fund that invests in oil and Tesla, for example. So those are real investments. The alternative is speculation. This is essentially gambling the price will move one way or the other. So changes in fundamentals or expected fundamentals are not speculation, but examples of the fundamental changes could be an increase in demand caused by growth in China, a decrease in supply due to a natural disaster. So we might see a hurricane cutting off the supply of gasoline because the hurricane shuts down refiners in the Gulf Coast. And Knittel and Pindick in a 2016 paper ask, what is the effect of speculation on oil prices? First, what's a speculative bubble? In a speculative bubble, investors keep buying an asset, driving up the price beyond its value based on fundamentals. How could this happen? So let's look at an example. In the late 90s, the price of Beanie Babies increased sharply due to a speculative bubble. Suppose you see the Beanie Baby price increase and expect them to continue to increase for at least another month. What should you do? You should buy because you think that the price is going to go up. You're going to hold on to Beanie Babies because you can sell them for a higher price in the future. If by doing so, you are increasing the demand for Beanie Babies and reinforcing the bubble. Now, it might be the case that Beanie Babies are not actually valued at this higher price, but enough people, enough investors think that the demand for Beanie Babies is increasing, but the demand is simply investors thinking that the Beanie Babies value is increasing. And so it's a reinforcement of the demand increase by the investors, and it's not truly a value increase because nobody except the investors is actually buying Beanie Babies and increasing the demand. Suppose you make investment decisions based on fundamentals and other investors do as well. What might happen to the Beanie Baby price next month? Well, we just said that if you hoard Beanie Babies, if you purchase Beanie Babies because you think that the price of Beanie Babies is going to go up, this is the same for oil, but kids actually don't want the Beanie Babies as much as investors do, so the value is not really there, the demand is not really there, then it's a bubble. And these investors will realize Beanie Babies are overvalued and sell them, causing a sharp decline in the price of Beanie Babies or a sell-off, and this increases the supply of Beanie Babies, will drive down the price of Beanie Babies. So this is what some people think happens in the oil market. It's not truly a change in fundamentals. It's not truly a change in demand, like increased growth in China or something. It's just financial markets deciding that oil is all of a sudden a valuable commodity and will be in the future, and so they're artificially increasing the demand. Inventories should rise during a speculative bubble, right? So we just said if you hold Beanie Babies, if you think the price of Beanie Babies is going to rise, you're going to hold Beanie Babies, creating inventories. Knittel and Pindick ask whether oil price increases were caused by a speculative bubble, i.e. speculators kept buying oil futures, pushing the price of futures contracts up. It is claimed that a speculative bubble would create a disconnect between the physical oil market and the futures market. What would be the response in the physical market? We'd see the sale of futures contracts at the bubble price, not at the actual price, the price that oil should be valued at. They'd sell less oil today, so spot prices will rise, right? So if we think that Beanie Babies are going to be more valuable in the future, we're going to hold on to them today, creating a shortage today, causing the current price or the spot price to go up, and then we would see increase in inventories. A storage of inventories for the future. So as we said, that if the investors are holding on to Beanie Babies, that's an increase in storage. Likewise, if investors are pushing up the price of oil, they're going to hold on to oil today because they think that the oil is going to be more expensive in the future, and therefore they want to sell it in the future. So does the evidence support this theory? Here's a graph of the history of oil inventories and oil prices. I would say no. The evidence does not support this. Just by looking at these two trends, inventories don't necessarily go up when the prices are going up. We see that in particular in 2008 when the prices rose dramatically, but the inventories went down. You could squint at this and probably find places where prices and inventories go in the same direction, but I don't immediately see the connection. So Knittel and Pindick decompose oil prices. By decompose, I mean using statistics to parse out pieces of the oil price, in particular the price that was due to speculative behavior. So this, and they ask how much of the observed change in oil prices was due to speculation. So here we have the dotted line showing cumulative changes in the oil price or log oil price. The dark or the black solid line is the cumulative change in the log price due to speculation, this decomposed oil price. You can see that there is no clear evidence that the change in oil price was due to speculation. This is just a bumpy line that's due to random noise in the oil prices. So if speculation doesn't drive oil prices, what does? And there's an economist named Lutz Killian that tries to answer this question. What drives oil price trends and volatility? An alternative explanation. So what's going to drive modern oil prices? Here's a picture of Lutz Killian on the bottom right-hand side. And these are the three. He decomposes the real price of crude oil from 1975 into 2000 to 2007 into three parts. So just like Knittel and Pindyck decomposed the price of oil into the proportion that's caused by speculation, Killian's going to decompose it into three different parts. The variation in the price of oil driven by crude oil supply shocks. So changes in the oil price caused by crude oil supply shocks. 2, variation driven by demand shocks that are specific to the global crude oil market. So changes in the price of crude oil that are driven by demand shocks that are specific to the crude oil market. Oil demand shocks called precautionary demand shocks. And then 3, variation driven by shocks to the global demand for all industrial economies. So this is more like a macroeconomic trend. Demand shocks to the entire economy. What is precautionary demand? So let's go into the second one a little more. Let's define this. This is the demand for oil storage. And this is going to be price variation driven by demand shocks that are specific to the global crude oil market. Precautionary demand shocks reflect rapid shifts in the market's assessment of the uncertainty about future oil supply shortfalls. In other words, if investors or refiners or people that buy oil decide that there's going to be a shortfall of oil in the near future, or they think that in other words, there's a tight market, the supply is going to be, demand is going to be higher than supply. There's going to be a run on oil in the future, causing what we call precautionary demand shocks, or shocks that are specific to the oil market. The premium, this is also considered the premium associated with ensuring access to inventory holdings. So if you're a refiner, you do not want to shut down your refinery in the event that there's a supply shortage in the near future, and so you're willing to pay a premium to ensure access to oil. So for example, if I'm a refiner, I'm willing to pay a premium to ensure oil delivery next month if I think there will be a shortfall in supply or an unexpected increase in demand. 2 things that can cause a tight oil market. Maybe you forecast hurricanes, or particularly hurricanes season, and so you're willing to pay a premium for the oil despite hurricane season. You can also think of this as worry entering the oil price, uncertainty entering the oil price. So Killian lays out 3 oil price principles. 1, increase in precautionary demand for crude oil. The thing we were just talking about causes an immediate, persistent, and large increase in the price of crude oil. That seems fairly obvious. The increase in demand causes an increase in price. And the increase in demand for crude oil specifically causes an increase in price. The precautionary demand. 2, an increase in aggregate demand for all industrial commodities causes a somewhat delayed but sustained increase in the price of oil. So this is more like a macroeconomic trend. As the global economy does better, or maybe a major player like China does better, then they're going to increase their demand for all industrial commodities, including oil. But whatever industrial commodities they are increasing their demand for requires oil for transportation, etc. So that's going to increase the price of oil. And then finally, crude oil supply shocks cause small temporary increases in the real price of oil within the first year, but they're short-lived. So this is Iran going offline, Saudi Arabia cutting their supply, OPEC cutting its supply can cause temporary increases in the real price of oil, but they're short-lived. Therefore, oil price shocks are driven mainly by global aggregate demand shocks and precautionary demand shocks, not oil supply shocks such as OPEC, which is commonly believed. So this paper kind of flew in the face of what most people thought was causing changes in the oil price. Most people thought that OPEC and supply changes were causing changes in the oil price, but in fact, it's not the case. It's mostly driven by changes in demand. And we've also seen it's not driven by speculation. So let's look at how Killian breaks down or decomposes the oil price. So Killian's principles in action. Number one, there's no long-term effects of oil supply shocks. So this figure here is showing you the variation in the oil price that's driven by changes in supply. Not a whole lot. It moves a bit, but it's not huge. Okay, what about demand shocks? Demand shocks that are specific to the oil market have long and persistent smooth effects. So we can see there's much more variation in the real price of crude oil based on demand shocks. Actually, these are not precautionary demand shocks. These are more long-term macroeconomic changes. So we can see what I'm pointing to here is I've got the price of crude oil in blue on the bottom, and Killian has decomposed it into the portion that's driven by demand shocks, and you can see this upward trend in the mid-2000s, and that's reflected in the blue line there right before the recession. And then finally, now we're going to talk about precautionary demand, or the oil market specific shocks that are short-lived and strong. And you can see a lot of the volatility, a lot of these short-term changes are caused by these precautionary demand shocks. And precautionary demand, these are oil market specific shocks. These can be investors, and most likely are investors. These are the demand for the commodity that's traded on the futures market, etc. And so I like this paper because it shows you what's causing the trends in the oil market, and that's going to be number 2 here. The long-term trends are driven by these macroeconomic changes. And the short-term volatility, the short-term changes in the oil price are driven by the demand that's specific to the oil market. It's the futures market, it's the worry entering the market by refineries, etc. So I like this because it really shows us what's causing the modern oil price movements. Let's summarize a little bit of what we've talked about. What explains trends in volatility in the price of oil? So let's look at an example, the trends of 2000 to 2008. What caused this upward trend from around 2000 to 2008? Was it speculation? Well, Knittel and Pindick say no. It wasn't caused by speculative trading. It was caused by changes in the market fundamentals, and Killian also showed this. Why? There was relatively inelastic short-run supply because supply has long lead times for exploration and development. We can't just go and start a new well, an oil well tomorrow. It takes time to find where the oil is, and then also to create wells. There was also unexpected demand growth that led to substantially higher prices. We'll see this in the following slides, that China and India's demand grew much faster than we initially thought it was going to. And so since supply is relatively inelastic, it couldn't respond quick enough, and so this caused tight oil markets, meaning that the supply was lower than demand, and this pushed prices upwards. The volatility, these sort of short-term wiggles in the oil price, that's caused by the precautionary demand. This is caused by refiners and other purchasers of oil. It's a specific demand to the oil market and the futures markets. So let's look at a little bit more detail of what's causing this upward trend from 2000 to 2008. You can see that here's the oil production and consumption in China. This is production within China and consumption within China. You can see consumption was much higher than production, meaning that China was going to the world oil market looking for a lot of oil during this period. Their economy was booming, and this caused an extremely tight oil market. We see the same thing happening in India. India's economy was booming as well, meaning they required a lot of oil. Their consumption was going up, while the production remained fairly constant, also leading to a tight global oil market. There's a lot of talk about the role of OPEC in oil prices. What role did they actually play? Most economists are skeptical that OPEC has had a large influence on oil prices. Why is that the case? Cartels are difficult to enforce. Most OPEC countries are extremely dependent on oil revenues, meaning that defections from the cartel output levels are frequent. A cartel really needs some sort of enforcement mechanism. If you've taken any sort of game theory, you can understand why this would be. And so what happens is OPEC will post quotas for every country, production quotas, and the countries will say they're going to produce a certain amount, but then they'll defect and produce more than that, meaning that the oil prices are lower than OPEC would like them to be. OPEC quotas and measured production levels are vague, so this is saying that it's hard to know what OPEC countries are actually producing. They set their quotas, but it's hard to go and measure what's coming out of every country. The EIA, and that's the Energy Information Administration, that's a U.S. government agency, and private organizations all have different estimates of OPEC production. So nobody really knows what these countries are producing. You can only see what effect it has on the market by looking at oil prices. OPEC would like to sustain higher prices, but they basically, economists have shown they can't do that because there's defections and prices are clearly not sustained at high levels. After 2007, OPEC had an aggregate target without specifying who should produce. In other words, this is another reason OPEC has failed. They set an aggregate production target for all the member countries, but they never said who was going to produce what. So they never got to the point of specifying which country was going to produce. If they set a production target of 100,000 barrels, that nobody said what fraction of that production target they were going to meet. Another reason OPEC doesn't have much power is that OPEC's market share is down. We've seen with the monopoly portion of this course so far that as the market becomes more competitive, there's less ability of any individual producer to affect the market price. And OPEC's market share at this point really isn't large enough to affect the market price. I think they're around 43% of the market share, and they're just not large enough to dominate the market. They can't act as a monopolist with a residual fringe of producers. This graph shows you the OPEC production and OPEC quotas. The black line is the quota. That's what OPEC was hoping that they could limit their production to. The other lines are the actual production estimates. You can see that production has almost consistently been greater than the quotas that they set for themselves. So they're basically always producing more than they say they will. So their cartel is failing. So some OPEC takeaways. OPEC pricing power has changed significantly over time. We didn't really cover OPEC prior to the early 2000s. OPEC, I've said a lot about how OPEC does not have power. this isn't to say that OPEC never had power. If you want to know more about OPEC's pricing power, I suggest you go back and read the book The Prize, which I mentioned in Module 5. That book goes into a lot more detail on OPEC's power. And here's some takeaways from that book plus what we've talked about. OPEC had no power prior to 1970. They weren't even a cartel prior to 1970, really. Most of the power was between 1970 and 1973. This is basically the only time they've been able to substantially change and control oil prices. After 1986, the prices were set in the balance between the spot and the futures market, which is subject to a trader's expectation of what OPEC says it will do relative to what it actually does. So 1986 is when oil became a commodity and was traded on futures exchanges. And so once that happened, you get millions of buyers and sellers, and so the market becomes essentially perfectly competitive, and OPEC no longer had any real power at that point. It only had power to the extent that it could convince traders what its quota was going to be, and then traders quickly learned that OPEC can't sustain its quotas, and so they kind of ignored them. So that's what this last bullet point says. Research in economics suggests OPEC announcements had virtually no effect after trading began, because the frequency of trading means that OPEC announcements have very short-term effects, like in the scale of hours. Trading happens almost continuously. Traders no longer believe OPEC can coordinate, and so OPEC's basically lost all its power.